Hi, I'm Journey Brown. Welcome to this week's MFB News. Hope you're really well and have something wonderful lined up for the Jubilee weekend. I am off to Dubrovnik actually. Really looking forward to it. I've never been there before. I've heard amazing things about it. It's meant to be beautiful, it's going to be hot, it's going to be sunny, and we're not taking the children. So it's going to be incredible. So I hope you also have something really nice lined up. The weather's looking a bit dodgy, isn't it, here? So I hope that anybody who's having a street party doesn't get rained off. Now, in terms of what we got for you this week, we're going to do our usual run through of what the lenders have been up to in the last few days. Now, we only did a video last Friday. That only leaves us 3 working days, well, 2 really, to cover off. You'd be amazed at how much has been going on in just a couple of working days from those lenders. They are busy little bees at the moment. Then we're going to share with you some information that's been released with regards to the housing market, tell you what's going on there. This is now information from Zoopla. Interesting data to share there. And then lastly, I'm going to be going through a report that I've read which talks about where the UK sits globally in terms of the number of private rental sector properties there are, so how big the buy-to-let market is comparatively. And actually I was quite surprised at the results. Lenders. Okay, so first up this week we've seen Aldermore withdraw a whole bunch of their products and are left with just 16 now, where the pricing is starting from 3.48. The products that they've removed, actually it's been a really broad range of buy-to-lets for single residential investment properties, some for multi-unit freehold blocks and HMOs, different loan to value. So really just kind of scale things right back. But they've still got 16 products and the pricing at 3.48 is kind of, not bad at all. Aldermore have some really niche bits of lending criteria. So for example, they are able to lend to not just SPBs but also trading companies. They can do day one remortgages, some bits and pieces like that. So quite a good offering there. We've seen the Mortgage Works increase some of their rates, which is a bit of a pity because they were looking incredibly competitive in the limited company space, where they have increased rates by up to 38 basis points. They've also made adjustments increasing HMO rates by up to 20 basis points, and their green mortgages have gone up by 26 basis points. In terms of where they're sitting now, they're still looking actually remarkably competitive, but just not quite as competitive as they were. So last week I found myself quoting the Mortgage Works more often than not for limited company applications as an example. Will I still be doing that going forward? Not as often as I was last week. The Principality have made some adjustments to their holiday let rates. Interestingly, they've gone down. Hooray, nice to see one person doing that. To 2 and 5 year fixed rates across their 60% loan to value range have actually reduced, marginally 0.08%, but it's still a reduction, which is quite unusual in the current climate. Now we've seen Precise Mortgages repriced. They brought out some new rates. Obviously they're more expensive than they were previously. 2-year pricing now starts from 2.89. 5-year rates now start from 3.44. They're within their range, and they have got a range of rates. They've also got some products with no arrangement fees, refund of valuations, and also £500 cash back. So really I think they're really driving for remortgage business more than purchase business at the moment, because they recognise that the remortgage market is running incredibly hot just now. The mortgage lender have increased their rates, as have West One. You may remember if you watched a video last week that Capital Home Loans had withdrawn rates and hadn't released anything at that point. They've now brought out their new product set. Their 5-year fixed rates are actually looking pretty good, starting from 3.15%. 7-year fixes from 3.55. It's a really interesting one. We're seeing more people looking at those longer fixed rates, so the 7 and 10 year offering. And actually these are looking quite good at the moment, and the reason for that is the swap rates on these longer fixed rate deals are actually quite low comparatively. So these rates are looking quite good. So actually people are quite interested in these at the moment. I've never had so many people ask me about 10-year fixed rates as I have in the last few weeks. So leading on from that, where are we now in terms of pricing from lenders? So for individuals, 2-year fixed rates are now from 2.15%, 5-year from 2.25%, and I'm going to throw in 10 years on the back of that for good measure. 10-year fixed rates from 2.45%. Now, if you're thinking about it, and actually just sort of echoing back to what I've just mentioned, if you are absolutely 100% certain that you're going to hang on to your buy-to-let property for 10 years, you're not going to want to raise any money out of it, you're not going to want to mess with it at all, you're just going to sit on it and let it just kind of tick over, then actually a 10-year fix can be a really wonderful option, especially when you consider that 5 years is 2.25, 10 years 2.45%. There's not a lot in it actually, which historically has not always been the case. So yeah, it's understandable why some landlords are actually thinking, well, you know what, I'm really comfortable with what I'm doing. I'm quite happy just to let things kind of play out. So 10-year fix is good for me. In the limited company space, slightly different story in terms of the margins for between 2 and 10 years. So 2-year fix 2.44, 5-year from 2.79 and 10-year from 3.54. So there's a much larger gap there between the 5 and the 10-year rates. But still, landlords are definitely asking about these in a limited company space as well. Heat now coming out of property market was the headline that I read the other day, which really grabbed my attention. And this was the title of a report that was published based on data that has been released from Zoopla. So first things first, the average price of a UK home has now broken through the £250,000 barrier for the first time ever, and has hit a new record high of £250,200. And this is according to the latest Zoopla House Price Index, which was published very recently. So, house prices rose by 8.4% in April, but the market is actually starting to show signs of slowing up because the actual growth in March was 9%. So it's gone from 9% in March to 8.4% in April. And the expectation is the annual rate of price growth is going to ease this year on a monthly basis, given that it's already starting to moderate. But reading through the report, what they went on to say is that the rate at which property values are rising is likely to ease during the year, but not expected to fall. So this is, I think, the bit that's really interesting, because there is still a huge number of people who are expecting a house price crash at some point. So a person called Graham Gilmore, who is the head of research at Zoopla, has said that given the number of homeowners on fixed rate mortgages, which protects them against interest rate rises in the short to medium term, the stress test carried out on those loans. So if you think about when you apply for a buy-to-let mortgage, there's a real buffer built into the affordability calculations for 145 at 5.5%. Even though you're taking an interest rate of 3%, that kind of stuff. And the same thing applies to residential mortgages, incidentally. Lenders are stressing mortgage affordability using projected much higher interest rates when they're calculating whether the mortgage is affordable. So that's what this refers to. Okay, and the healthy employment market, we're not expecting a raft of fall sales in 2022, which usually triggers price falls. So Wales has saw the strongest price gains for the 15th consecutive month, with prices rising by 11.6%, although this was down from growth of 13% recorded in February. So really performing well, Wales, but actually slowing down there as well. Wales was followed by the South West at 10.5% and the East Midlands at 10.2%. Meanwhile, London continued to lag compared with other regions, posting a growth of just 3.6%. Now, in terms of individual cities where properties remains more affordable, these cities continue to see the strongest value gains. So Nottingham led the way, with house prices increasing by 10% over the past year, followed by Liverpool at 9.9% and Bournemouth at 9.7%. I find that interesting, actually. I wouldn't class Bournemouth as a city which has low values, given what I hear from clients who are looking to invest there. Maybe they're looking at HMOs and larger properties, but that one surprised me. Anyway, Zoopla said the housing market remains significantly busier than before the pandemic, but there are signs that activity is starting to slow. And going back to what we're always saying, week on week, which I know is probably starting to get a bit repetitive, demand continues to outweigh supply. The number of potential buyers currently 61% higher than the 5-year average. Meanwhile, the level of homes for sale is 37% lower than normal. But the number of properties being put up for sale is beginning to increase. The number of new listings in the 4 weeks to May 2022 was 7% higher than the 5-year average. Homes also took longer to sell than during the previous month for nearly all property types. So while with that I say, really what we can deduce from this is that house prices are still growing, but they're starting to slow down. No one is expecting to fall off a cliff, absolutely, but definitely things, well, the heat, I guess, is really starting to come out of the market. Okay, now a really interesting report came out in terms of where the UK sits globally in terms of percentage of number of properties which are rented rather than owned by the occupier. Now, I don't know about you, but I've always had this kind of thing that we, the Brits, love to own our homes. Our home is our castle. The rest of Europe, they're really into renting for their whole lives, but actually we like to own our properties. So this is why I think this report is really interesting. So the number of properties in the UK, across the UK, has climbed over 1.1 million in the last decade. Now, this is all according to data by a specialist rental platform called Acasa. So that increase has placed the UK in the top 10 globally when it comes to the balance between home ownership and renting. So Acasa analysed current dwelling stock to find out what proportion of the UK property market is accounted for by the rental sector, comparing this to other nations, as well as looking how this balance has shifted in the last 10 years. The analysis showed that a decade ago there were just shy of 27.5 million total dwellings in the UK property market, with almost 9.4 million rental properties. So at this point, the UK rental market accounted for 34.2% of all dwellings. Now, if you fast forward a decade, this proportion has shifted, with even more people becoming reliant on the rental sector in order to put a roof over their heads. With the latest figure showing there are now over 29.5 dwellings in the UK market, a 7.5% increase versus 10 years ago. The number of rental properties now stands at over 10.5 million, meaning this area of the market has not only seen a larger rate of growth at 12.2%, but now accounts for 35.7% of total UK dwellings. Now, while the 1.5% increase in market share may not sound that significant, it now means that there are now over 1.1 million more rental properties across the UK than there were a decade ago. And what this means is that the UK is now placed at number 10 in the list when it comes to the nations with the largest reliance on their respective rental markets. So, interestingly, Switzerland sits at the top, where its rental sector accounts for 57.7% of the overall market. Hong Kong is at 50.2% and Germany is at 49.6%. Other nations to rank ahead of the UK are Austria, Turkey, South Korea, Denmark, Japan and France. But what I think is just really interesting is how actually, while people are sort of saying, in the UK people just want to own their homes, people are divesting from the UK rental market, actually these statistics actually fly in the face of that, which really shows, I think, going forwards the kind of shift in terms of sort of British people's mentality. More people are much more content simply just to rent property, and actually going forwards I suspect that will continue to grow. So actually what this really kind of underpins for me is that there really is a really strong place in the UK property market for the private rental sector. And that is everything for me this week. So all that's left for me to do is remind you that if you do have any questions, we are very, very happy to have a chat with you. 0345 345 6788, or have a look at our website, mortgagesforbusiness.co.uk. Do have a wonderful Jubilee weekend. I hope you all feel very, very rested and have a lovely, lovely time. And I will catch you again next Friday.